Gold is just extremely scary and expensive at these levels. It's just versus any moving average with 60-month, 200-day. It's in like the third or fourth standard deviation.
That sort of supply side disruption element probably puts a floor on the price. I'm calling for 10,000 being a good floor, just simply because of all the supply side problems we've got in the market.
The next 2.5 months is we absolutely need the U.S. stock market to stay up and to go up, because if it doesn't, things like crude oil that are going down despite the stock market going up, and bond yields that are going down despite the stock market going up, those trends will probably accelerate. And that's why I'm really concerned when I can make statements about gold having its fourth best year of the last 100 years right now.
Actually, someone said it in the chat. I love it. Nobody cares about ESG anymore. Do you think that's right? Does nobody care about ESG anymore?
No, that's certainly not the case. But I think what has happened is, and I attended some conferences over the LME week, which is which we held. It's all the great and good descend on London. And one of the mining CEOs put it very, very well. He said, look, in 2020, 21, 22, all his investor meetings were all about ESG. 80% was ESG, and 20% growth, cash flow, etc. And now he says nobody asks him about it. But that doesn't mean that they don't care about it. It means it's a hygiene factor. The mining companies, you just have to be on top of it.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy and commodity markets. For the call today, we've got two great speakers who are on our commodities team. So first, we've got Grant Spohr joining from London. He's our lead metals and mining analyst. If you don't know Grant, he'll get an opportunity to introduce his franchise here today. And then swinging across the pond, we've got Mike McGlone, regular on this call, here in Miami with me. So that's the crew for today. And look, there are a number of very interesting things happening in the commodity space here at the moment. We've got rallies in some commodities. We've got declining trends in other commodities, particularly some of the energy ones. Oil in particular has been pulled back close to 20% year to date. So Grant, I want to come to you first, since you're our special guest here today, and just get your lay of the land. I think a lot of folks who are in the energy world pay a little bit of attention to some of the metals in your space, particularly copper. Has got a pretty big energy transition importance, or just electrification importance, if you're thinking about all the information and takes on AI and data centers. So Grant, maybe 30,000 foot, give us your lay of the land on copper and some of the other important metals, if you don't mind.
Sure. So as you say, copper's got a great bullish secular demand story behind it. Simply put, if you want to electrify, you need copper. But it's not all one way. So, there is a tussle between the bulls and the bears in the market from a demand perspective. We've got, on the other hand, on the sort of bearish end of the spectrum, we've got China's economy, which is maturing. And the drivers that drove copper demand, let's say, over the past 10 to 15 years are starting to wane. But then you've got this whole new swathe of demand drivers. EVs, they're much more copper intensive than regular petrol engines. You've got data centers, and perhaps data centers themselves aren't that copper intensive, but the implication for the power and the infrastructure you need to support that is very positive for copper demand, as well as all your renewables, which are copper intensive. So, and the way I put it together, and I'm sort of probably taking quite a neutral demand view or a sort of a more modest demand view. I'm sort of saying, look, the two kind of offset each other, and all that we're seeing is the natural evolution of demand for copper. It's a very versatile metal, and we're going to keep demand at or maybe slightly above trend. So that's around 2.5%. So that's global GDP. The multiplier is around 0.7 or 0.8. And we've got enough new demand sources to keep copper going, keep the demand at that sort of level. But in the short term, I mean, what's really driving copper, and I would say, sorry, just to take a step back, I'd say, look, all of that is intact. China's economy is just starting to slow a little bit. So, on the short-term demand signals I'm getting, we're probably heading for a bit of a sticky patch. But what's keeping copper elevated is all of the supply side disruptions. And that's really, been the main story of copper, certainly over the past 6 months. I mean, I can point to three particular incidents. We've had three very, very big mines have underground accidents, some of them fatal, sadly, and that's taken out a good, 2 to 3% of the world's copper supply. Now, because the copper market is notorious for never delivering what it says it's going to deliver, we as analysts all put in what we call a disruption allowance, equivalent to about 6% of the original supply. And we just monitor how much of that is being chewed through. But this year we've chewed through all of it, and we haven't even quite reached the end of the year. And we're probably going to take out some supply that we thought was going to happen next year. So as a result, a market that was balanced is now sort of in deficit. And that, that sort of supply side disruption element probably puts a floor on the price. I'm calling for 10,000 being a good floor, just simply because of all the supply side problems we've got in the market.
Okay, that's a wonderful framing. Thank you so much for that setup, Grant. Okay, Mike, I want to get you into the conversation here. Grant's given us a relatively bullish take. I guess you got some good demand stories, some supply driven factors that help you set that floor for copper. Mike, I know you think about all the commodities, but okay, how do you respond to that, and how do you frame it against your bearish view on the energy commodities?
Yeah, I'm first of all, I completely appreciate and depend on Grant's fundamental in the weeds view of all the base metals, all the metals, most notably copper, and I agree with them, particularly versus crude oil. As if you look at that crude oil versus copper ratio, copper divided by crude oil ratio, it's been going straight up. When I think electrification, first place I go is silver, and silver is one of the best performing commodities this year. It's the best conductor of electricity, obviously means solar panels, but to me it's the macro bigger picture that matters. And just the fact I have to hop off this call early today because radio wants me to talk about, guess what, gold, is a probably sign that gold's getting expensive, and gold's been lifting up all the metals. So the macro view I have for all metals is very similar to gold is just extremely scary and expensive at these levels. It's just versus any moving average with 60-month, 200-day. It's and they're like the third or fourth standard deviation. I like to, my colleagues like to use a lot of standard deviations. That's 0.001 probability. It's the highest in decades in some cases. It's just not where you want to get long gold. The problem is it's happening in an environment when U.S. stock market is just getting crushed. The last time that happened was 2006. So it's almost 20 years. And that was part of that big gold rally. And it was preceding the crisis. So I'm very concerned about the scary signals that gold's telling us. At the same time, with crude oil dropping 20% in the year, that disparity right now at 70% is the greatest in history. 100 years. And of course, crude oil didn't matter 100 years ago, and gold was money. It was, but it was the standard exchange rate. So that's how extreme we are. And it's really concerning to me what's happening towards the end of the year and what will happen towards the end of the year. So I'm thinking that the risks are that stock market volatility continues to recover. Now, last thing that's significant is 90-day volatility, S&P 500, just bottomed on October 6th at 8.9%. Now it's around 10%. That was the lowest in 5 years. What's unique about that? That's the exact same time that Bitcoin peaked. And Bitcoin is showing, the digital version of gold, which is a leading indicator for all risk assets. It's showing major divergent weakness this year. It's up about the same as the S&P 500, despite trading 3 times the volatility. So I'm looking at the macro big picture elephant in the room as we head towards the end of the year. The next 2.5 months is we absolutely need the U.S. stock market to stay up and to go up. Because if it doesn't, things like crude oil that are going down despite the stock market going up, and bond yields that are going down despite the stock market going up, those trends will probably accelerate. And that's why I'm really concerned when I can make statements about gold having its fourth best year of the last 100 years right now. And sure, it's coming off its highs, but it's way expensive. So I'll put some numbers in that. Gold, obviously, first key support's around 4,000. Resistance is who knows where, but when people talk about 5,000, it's already scary now, Stretch. Getting towards 5,000 is just extraordinarily frightful. And a normal correction from this kind of overbought in gold is 3,500. That's just normal, like 20%. It's not a big deal. Copper, I think so. I do enjoy. I've been focusing more on U.S. copper this year, partly because it's been the center of the universe with this wonderful president we have, and it's locked at $5. I do like to use the U.S. price sometimes, partly because if you overlay it with the bond yield, it's like the same over time, right? Certainly the 30-year. Overlay it with CGBs, Chinese government bonds, typically has been the same, and they're melting. Iron ore has been going lower. Crude oil has been going lower. Copper is strong. Grant pointed out why. I think the key risk is the stock market has a little backup in the year, say drops 5 or 10%. Copper can drop 10 or 20% easily. And what you see what's happened this year was up 30% for a while. It's dropped right back down, and it's hovering with the S&P 500 up on the S&P 500. It's about 15%. Copper is just about 20%. It's all dependent. That's how dependent we are right now. So I look at this next few months as U.S. stock market volatility has to stay subdued. The market has to stay resilient. And all the signals I have from commodities are we're due for a potential beginning of a great reset. And to point that out is we've just never had gold going up this much and crude oil going down this much on an annual basis ever. So simple statements like that. So any other numbers on it? Also, the thing about crude oil is not alone in its trajectory towards a lower price cure. If someone someone's needs to mute themselves, is that it's not just crude oil, it's the grains. Certainly corn, soybeans, and wheat. So I'll end with one place too. Is natural gas is a big wild card this year. And the natural gas popped last year in the coldest winter in 10 or 20 years. And it's still priced for a colder than normal winter, despite global warming trends. So if we get another colder than warmer winter, we're going to push back in those global warming trends. And these natural gas popped up to Jan natural gas. It's the peak of the bell curve. Popped up to near almost 6 in March. Now it bottomed to around 4. It's hovering there, and I think the risk heads towards 3 or 2 if we get a normal trend back to warmer than normal winters. And if that happens, that's the commodity dominoes falling for deflation and leaves gold as an outlier and copper stuck in the middle.
Thank you, Mike. Maybe just to get a quick read from you on the BCOM index. So I'm just looking, and unlike some of the energy commodities, we already hit oil being down. U.S. gas is flattish. European gas is down quite a bit. Do you think that the entire BCOM index could reflect that bearish sentiment? Are there things embedded within that maybe contrast your overall narrative?
Oh yeah. So if the U.S. stock market drops 10%, BCOM can easily drop. It might not drop as much. The good news is because the highest single weight in the BCOM index right now is gold, and gold is the best performing commodity in the BCOM. The best performing sector this year are the precious metals, up 44%. BCOM's up 13%. In a year with the stock market up 15% and the dollar down about 8%, that's about what you'd expect. It's actually somewhat poor performance. But the bottom line is what's driving is the metals. And it also tilts me over to this Bloomberg All Metals Index. I encouraged our index team to launch this almost a decade ago. To me, that's the place to always remember the bottom line in commodities if you want to buy and hold and measure and hold actual commodities. Metals are typically the best place to be. Grant will pointed out too, is they're the easiest to store. They're never really pay a lot of contango in the curve, and what's the benchmark for them is gold. So I'm really worried. Bottom line is BCOM will probably be fine as long as the stock market stays resilient. Bitcoin will probably be fine as long as the stock market remains resilient. You see all the problems. They're all underperforming the stock market this year. And it's getting towards that end of the year where I'll end with this. The key thing I also watch is that Bloomberg Galaxy Crypto Index. It was up 30% in the year. Now it's 10. You're getting towards the end of the year, and it just says an ex-trader and running leveraged money. Once you get towards the end of the year, you still got some profits and the fundamentals might be fading. You hit stops. You just get out and say, thank you. I can still get that GI Joe with the Kung Fu grip for my kid if I preserve some profits. The risk is that we start kicking down at the end of the year, that dominoes get tumbled. So that's what I'm worried about with broad commodities. And the bottom line, I'll end with this, is typically commodities, mostly the elastic commodities, have to get below their average cost of production and offset those excesses supply and demand. Now we know in WTI crude oil in the US, it's around $55 a barrel. This year's low is 55. And we still have excess of supply. We get that. And the grains, corn's around $3.75, and corn's hovering around $4. Unfortunately, you still have some pain to go, particularly to get to that low price cure, unless there's some kind of supply shock like Russians' invasion of Ukraine, which I can't predict.
Thank you so much, Mike. And for anyone listening, we've got a few commodity focused dashboards. If you type BICOMDG, you can hit our just general commodity dashboard. We've got a copper dashboard. That's BICOPPG. So make sure to check those out. And of course, myself, Grant, Mike, we're all green dots on the terminal right now. And we're happy to engage on any of these topics if you have follow-up questions that are specific to your purposes. So Grant, I want to come back to you now. So Mike laid out a sort of general bearish sentiment on the commodity landscape and really tied it to kind of this idea that if there's any slippage in the sort of broader equity markets, that could spell some pretty bearish sentiment for the commodities generally. I'm curious what you make of it, and I'm also curious if you've got a fundamental call on the gold side of the equation.
So let me deal with the sort of equity market aspect of the question. Look, the equity market tends to be slightly faster moving compared to the commodity market. So it tends to price in or anticipate things a lot quicker than commodity markets. So it can be a good lead indicator. So look, there's no doubt that if the S&P 500 drops, I would suspect that base metals specifically would also drop, would give up some of their gains that we've seen. Particularly in commodities like, some of the more smaller commodities where they've also tended to be lifted by a rising tide, and the fundamentals aren't nearly as strong or compelling as the case I laid out for copper. So I do think there is a bit of, let's say, speculative money in the commodity trade. So there's, how can I put it? There has been a call for, you need to up your allocation of commodities because it's a hard asset. So I think some of that money will wash out a little bit. So yeah, I would agree with that, but I don't think that the fall is going to be that sharp because, again, it's the US equity market. It's very tied to tech, and US tech isn't really a big demander of mainstream commodities. So, from a demand perspective, the signal a drop in the S&P 500 is going to give isn't going to be, I don't believe is going to be that important. Yes, the world is a little bit overheated in some asset classes, and that's the signal it'll give. But I don't think it's going to give a massive demand kind of signal to commodities land. Gold is very, very interesting in how it behaves juxtaposed the US equity market. Historically, you should have a strong inverse correlation with the S&P 500, and typically, even if I just segue into equities a little bit, we apply we're trying to value a gold equity. The discount rate we apply is typically 5%. Now, why 5%? Because the beta for gold companies was typically negative versus the S&P 500. And that's why you had to have gold companies in as a sort of a risk, a hedge in your portfolio. More recently, over the past few years, that hasn't been the case. The S&P and gold have been pretty much correlated. The one has gone up and the other one has gone up in tandem. So that makes the sort of, how to call it a little bit difficult, and we have to sort of, I'll pull one of the pages out of Mike's playbook. We'll have to go to history, and we'll have to see what happened. And in 2009, what we did see is when we had the big collapse, gold also sold off, but then it rallied quite sharply afterwards, as and it was a funding trade to cover positions and margin calls, etc. initially. So if we have a sharp correction in the equity market again, the first move is probably going to be down, I would suggest, because there is going to be some liquidation, and you need to find pools of liquidity. And gold, I think at these levels, probably offers some liquidity. But then I have to say, I think it comes into its own and then probably acts as this hedge against, risk, shall we say. And I think we do get might sell off, but then it'll rally sharply quite soon afterwards. So that's my call on how gold will behave in let's say, an equity market sell-off.
I'm going to follow up and just ask if silver basically is going to track with gold, and the tie in there, for me at least, is that for anyone who's unaware, silver is actually an input to the solar supply chain, something like 10-ish%, maybe a little less, a little more, depending on which company, who you ask, that kind of thing, but is an input to solar module costs. So curious to see if you kind of have the same view on where silver could go.
So silver is a real challenging market, challenging metal to try and analyze, right? Because it sits, gold, you can say is not really a metal; it's a quasi currency. So you can apply that sort of analytical framework to gold. Copper is an industrial metal, and I'm a micro guy, I'll admit that, and sort of fundamental supply demand, that's the best way to look at the gold market, the copper market. And silver sits somewhere smack bang in between. So, the way I think about silver is, and certainly how it's behaved empirically over time, is you've almost got to think of this elastic band tied to gold. And as gold goes up, silver goes up with it. But it's there's an elastic band tied to it, and there's a bit of a weight hanging on silver. So as gold tracks up slowly, silver will go up with it, but typically the spread widens, and then all of a sudden, and it's very difficult to predict what that catalyst will be, that somebody snips that elastic band and then gold shoots up. And that's what we've seen recently. And I think it's more a case of, people pile into gold and then it gets expensive. And gold, even now after the correction, is super expensive versus everything else other than the S&P 500. And I think the market looks at anything else shiny, and we've seen it in platinum. We've even seen it in palladium, which is an industrial metal by all other ways that you want to measure it, start to rally as anything shiny has sort of ridden gold's coattails. So I do think silver's, we've seen it rally very hard, but I think with this correction, we're gonna see it drop out. And the reality is, if we look at it on a purely industrial basis, then silver is often in a surplus, and it's only the investment demand that soaks up the excess and sort of gives you that balance in the market. So, from an purely industrial perspective, silver's not in short supply, unless we suddenly get this massive uptick in silver demand and we start to use silver in, a lot of electrification applications. And even in solar, I mean, there's a lot of work that's gone into thrifting in the solar industry. So I'm a bit more cautious on silver. So I think it'll trade, as we saw it did in 2011. It shot up and then it retraced. So I think I think we've seen the peak. I don't see it breaking $50 again. But that said, we'll have to see how gold, and unashamedly, we tie our sort of silver view on our silver forecast to where we think gold prices are going to go.
Okay, I wanna. This is very helpful for my own franchise. I'm gonna ask you another metals question to help make sure I'm calibrated correctly. So let's hit steel while we're at it too. So steel, big input costs for the wind industry. Anyone who knows the space, a few years ago, there's a big rally in steel prices that kind of followed a lot of the other commodities up. The wind turbine manufacturers were effectively unhedged and their margins got obliterated when their input costs went up and they weren't able to pass those on to their customers. Steel has retreated something like 50% since the 2022 high. But give me a sense. What's your vibe check on where steel's at and where it could be headed?
Yeah, so steel again, you've got to. It's quite tough. You've got to look at it more on a regionalized basis, and it is one of the most sort of protected commodities globally. So, the whole focus in the US was protecting steel and aluminium, but steel was the focus. So you've got very high barriers to entry in the US. And very more recently, we've seen the similar sort of framework being applied to the EU. So both, big sort of importers of steel are throwing up the barriers. So, I mean, that is going to be inflationary because it inhibits the sort of free flow of steel across the globe. But the reality is we've got overcapacity in steel. There's massive overcapacity, and not only in China, everywhere else as well. But it's most notable in China. So we've seen, and I've talked about the sort of maturing of the Chinese economy, and it's through the bulks particularly that we're seeing most of that, right? So iron ore, metallurgical coal, which are all inputs to steel, those are the ones that have been most deflationary because of a slowdown in infrastructure and indeed the property market. So China's effectively been a deflationary force in steel, so we've seen steel prices come down and under pressure. What's a bit more difficult is now you've got all these barriers, so that's going to prevent some regions from benefiting or suffering, depending which side of the coin you're on, from that deflationary force. So, but I do think because of the overcapacity in a lot of areas, steel prices are going to be pretty range bound and probably the trend is likely to be down. Now, I will say in China, a lot of people are loss making at the moment. So I think they're going to struggle to see that price appreciate, that price going lower. So I think we reached a bottom in China, but everywhere else, I think prices might creep up because you've got those trade barriers.
I wanna get your sense a little more on the trade component to this. And so, obviously the Trump administration has made trade and tariffs a sort of central part of your thesis. And I like how you broke the steel market down into sort of these sub-regional markets. Just generally in the metal space, are you seeing more difficulty getting the materials to the markets where they're most needed? Are trade tensions generally flowing into your thesis? And give me a sense of how different that's been year to date this year versus how you might have been thinking about it a year or so ago.
Yeah, no. So I mean, let's go to the copper market. So I mean, we go back to when Russia invaded Ukraine, and that was the first sort of, let's call it, supply chain shock. But I will say what we did see is we saw a lot of rerouting of trade flows, and a lot of Russian materials basically gone into China, and from there, China's become a bit more of an exporter of nickel, copper, things like that. So we've just seen it reroute, and that didn't take very long at all. But what I will, the one that surprised me this year was copper particularly. And, many commodity traders will describe this year as a opportunity in a lifetime, where we saw the arb, or the spread between the COMEX, the US price, and the London price. It was over at a dollar a pound at one point. So I think it's that that I wouldn't have ever thought of analyzing the copper market on the basis that there was going to be a trade barrier for copper, given that the US is short copper. But what it's meant is the way that I have to sort of think about it is there's almost been a de facto buildup of a strategic stockpile of copper in the US, and that sucked metal away from everywhere else in the world. So, I kind of almost have to, to a certain extent, think of it as, previously you used to think of it China non-China. I almost have to think of it as US non-US, and try and sort of create a look at the balance outside of the US. And then see how tight the market is. And perhaps, from a London price, an LME price, that might be influential. Because, at the moment that metal, 600,000 tons, is stuck in the US. Now, whether the US is actually going to consume it quickly, I have some doubts on that, but it's probably stuck there. So it's almost sterilized. So that's been an interesting dynamic in the market, which, I haven't really had to contend with previously.
Okay, Grant, one more question to maybe round us out here. And just looking at the MSCI Global Metals Producer Index, and it looks like it's outperformed the broader world index. If you look at the energy index, the MSCI, that's more oil weighted, it's underperformed the world index. Not surprising given what's happened in some of the energy commodities. I would note that the wind and solar indices are actually outperforming the world index, kind of on par with, looks like, with where the metals and mining names are. And so I just want to get your sense on kind of the equity side of the equation. How are the companies performing in this market? Are they are they hedged? Or do they tend to move in line with the commodities? Or do they have a good fundamental setup given all of the discussion you've been laying out here over the last half hour?
So it depends from sector to sector, to be honest. So I would say, but as a sort of a broad brushstroke, I think the sector in general came into this sort of upcycle that there was a big down cycle in 2015, 2016, and all the companies pulled back on their capital spend, and they didn't invest. And basically, investors sort of said to them, look, we want to see the cash returns because you splurged in the previous cycle and you wasted capital. So we're not going to give you that opportunity to do it again. But they pulled back too much. And so they've entered this sort of, let's call it, particularly in copper and gold, this upcycle with very few shovel-ready projects. So from a growth of, pure volume growth perspective, they haven't really they weren't really that well positioned to try and to deliver new tons into this high price environment. So many of them have reverted to M&A, and there's been some high profile attempts. In the gold sector particularly, there's been loads of M&A. And in fact, because the gold price has been so strong for so long and it's rallied so hard, that M&A has paid off. But it's, in mining, there are very few synergies with M&A. There's very few operational synergies. So you have to get your timing right. And the gold guys have got their timing right. So that's been pretty strong. And they've actually now, with this last leg up in gold, have really benefited from that. So that's part of the reason all the gold producers have been, have done very, very well, and their balance sheets, they're pretty much delevered now because of all the cash flows coming in. So, they're looking well positioned. The copper diversified miners, probably a little bit more constrained because they're having to invest so much. So their cash flows are, they're basically spending everything they're earning on capital, some catch-up capital and growth. So, they probably, if they were honest, would have said, I wish we'd invested a little bit more, a little bit earlier, so we're better positioned for this price environment that we're seeing today.
You know, I said that was going to be the last question, but I thought of one more that I want to ask you since we don't have you as a regular, Grant. In general, I think we've seen a big pullback in kind of how folks are thinking about ESG factors and how they apply to most of the names in the energy complex. But I know that you and I over the years, you know, I do think ESG has been a sort of criteria for how you might think about some of the metals and mining names, particularly maybe on the S side, right? Not always just the E side. So, and there might be a bifurcation between U.S. and European investors on that front, but and actually someone said it in the chat. I love it. Nobody cares about ESG anymore. Do you think that's right? Does nobody care about ESG anymore?
No, that's certainly not the case. But I think what has happened is, and I attended some conferences over the LME week, which is which we held. It's all the great and good descend on London. And one of the mining CEOs put it very, very well. He said, look, in 2020, 21, 22, all his investor meetings were all about ESG. 80% was ESG, and 20% growth, cash flow, etc. And now he says nobody asks him about it. But that doesn't mean that they don't care about it. It means it's a hygiene factor. The mining companies, you just have to be on top of it. Social, are you dealing fairly with the communities? Are you looking after your employees? And it's a hygiene factor. You just have to do it, and it's so entrenched within the mining companies to focus on it on a day-to-day basis. And I think that was always the case. The only thing that they had to adapt to is how did they report that, and how did they glam it up a little bit for the ESG investors to say this is all the things that we're doing, because it's very, very, you can lose your social license very, very quickly. And we've seen that in Panama with First Quantum. Government communities protested and they shut the mine down. Now it's a long, laborious process to try and get that mine restarted again. So I think investors are worrying less about it, but I think the fundamental assumption is you're doing it anyway, and and if you aren't, and we find out about it, I guess that's gonna be a problem.
Awesome. I think that's a great place to end. And again, I know this is more of an energy focused crowd, but I really appreciate you coming and talking commodities with us generally here, Grant. I think the energy transition piece and kind of how these markets all weave together is always interesting to think through. So for everyone who's listening, if you don't follow Grant, make sure to send him an IB. I think you guys have a client chat as well. Is that right, Grant?
Yeah, we have a client chat, yes, which is apparently it's not quite as spicy as the oil chat, but
fair enough. So yeah, we've got two energy focused chats. We've got the more traditional one, and then we've also got a more energy transition oriented one, and they're both fairly active. But yeah, so make sure you join the chat so you can kind of continue this conversation for everyone who's listening. And we love to hear from you. So follow up with us on any of these topics and ask us more questions. Take care, everyone, and we'll talk to you next week. Cheers.
thank you.